Grazie, buongiorno a tutti, grazie per dedicarci il tempo a questa conference call che sta per iniziare. Parlerà tra poco Marc Chapman, gestore del nostro fondo Long Short Equity europeo, Edge Invest Principia Fund. Ringrazio Marc fin d'ora, come al solito ricordo che alla fine, come vi è stato ricordato, ci sarà la possibilità di fare domande o eventualmente sempre siamo tutto il team marketing a disposizione per raccogliere domande da girare successivamente ai gestori. Siamo particolarmente contenti di ospitare oggi Marc. Il fondo, in un contesto di mercato di riferimento, quello europeo, molto complicato, si sta distinguendo grazie in termini di performance aggiustata per il rischio, quindi siamo curiosi di sentire quello che ci dirà Marc tra poco. Marc, please go ahead. Are you going to speak in Italian?
Of course, yes.
No, yeah, okay. Only for this time in English, okay. Thank you, Marc.
Thank you very much for your interest. I'll start by reviewing what's happened in the past few months and what's driven the markets, and then go on to explain the position of the fund during that time, and then give an outlook for the overall European equity market with some interesting company picks that we think have good upside over the next 12 months. So just look at the last few months. Essentially, since Brexit, there was an unexpected rebound in the European equity market. The market itself went up about 5%. Within that, it was more the cyclicals which went up stronger, so the banks went up 10%. And also, surprisingly, at that time, volatility declined aggressively from a level of around 35, 40 at the time of the Brexit to below 20 now. And this again meant that risky assets, which were underweight in the market, performed well. Now, just one step back, in terms of the context of the market over the recent time, we think that the decline in interest rates has supported a continued appreciation of obviously the fixed income market and also long duration assets and equities. So bond proxies and long duration stocks such as toll motorways or concession assets have performed well. And while there's been underperformance in cyclicals and financials because of weaker economic growth and also because of the issues around the financial sector. Now, moving on to the passive earnings, this is important for the direction of the equity market. At the start of 2016, earnings expectations for the following year expected around a plus 14-15% EPS growth. And that was based on a recovery in some of the cyclical sectors, an improvement in the commodity market, and stabilization in the financial sector. Now, in the first half of 2016, these things didn't happen. So there's been downgrades from both a top-down level and also a bottom-up level, a sector level, for the European earnings outlook. So during the first half, the earnings outlook was cut from a mid-teens EPS growth to a single-digit earnings growth. Together with the macro shocks, concerns over China, concerns over the US, this led to the current position of the European equity market, we think. So within that, essentially, the fund is very concentrated on stock-specific dynamics. So since the end of June, the NAV is up about 1.7% over that time period, but that's been completely driven by the performance of a certain few positions which have performed well for stock-specific considerations. So I would highlight two names which have been positive for the fund in the past few months. So one is Entertainment One in the UK, which is a media company. And this company essentially has a few assets. It owns the Peppa Pig franchise, which is a cartoon and a merchandising rights for children's TV. It also has a TV production business which makes series which go on Netflix, Amazon, and all distribution channels. It also has a film distribution business. Now, essentially, the company has been in a recovery position. At the end of last year, it did a rights issue to buy the remaining part of Peppa Pig that it didn't own. And since then, the market's been concerned about its cash flow dynamics. We've been buying shares since the end of last year, and we bought a lot in the spring of this year after having conversations with the CEO because we thought the upside was significant. In the past few months, there's been some crystallization of that upside, So the company was bid for in August, and then the bid was withdrawn. And then lately, the company has said that earnings estimates are in line with their guidance, and the valuation is very attractive. So I think there's still good upside on this position, but it's been a good performer during 2016. And then another one I'd highlight in August is Interserve in the UK, which is basically a company which does construction activities in the UK and internationally, and also has public sector assets, so it helps the government outsource certain activities of the government, such as prisons, hospitals, probation services. And over the past 18 months, the company's had 2 profit warnings because of some cost overruns in construction and a weaker mix in their core UK business. All of those issues are now receding. So when we met the company in the spring, I thought that earnings expectations were at a trough level. The market was very negative towards the company, and earnings estimates have been reduced aggressively. At that point, it was extremely good value, at about 5 times price to earnings. Since then, it delivered inline estimates, inline results in August, and the stock appreciated very aggressively during that month. It was up 40% during the month. And then in September, the NAV has slightly declined, and that's basically, again, a couple of stock-specific names. So Corian in France, which owns nursing homes, gave out guidance which was more conservative than investors expected. That led to a share price decline. We've since met the company and decided that their forecasts are conservative and that they'll be surpassed going forward. So we think now is a good opportunity to buy it. And also Interserve, which fell in September, essentially because of some concerns over UK-exposed companies because of the Brexit negotiations starting to happen in earnest now. So in the context of the market's volatility, the fund's performance has been driven by individual names such as these, where we've considered that expectations towards the company have either got very negative and very concerned, and where we think earnings estimates can improve going forward and can surpass what the market expects. And when that happens, you can get an aggressive share price reaction like happened in Interserve in August. Now, in terms of an outlook for what we think going forward, essentially the tailwind from lower interest rates, which has driven the fixed income market and the long duration stocks in the stock market, is probably now complete. We think that there's unlikely to be any further declines in yields, which means that there's unlikely to be any more gains in long duration stocks. And things like food manufacturing, consumer staples have become very expensive on absolute PE basis, and the earnings growth on offer is actually not so attractive. So they've re-rated essentially because they've been treated like quasi-bonds. So the tailwind from the decline in interest rates we think is complete, and that won't be a driver. On earnings estimates, we think consensus estimates for 2016 are now fair. So they came down during the first half, and since then they've been stable. So overall, the market expects about plus 6% in terms of EPS growth for 2016, and plus 11% for 2017, excluding the financial sector. Based on our company analysis and meeting lots of companies around Europe and doing a lot of bottom-up research on these names, we think those estimates are fair. So that if Q3 earnings are in line or slightly better than the market thinks, then we think there's perhaps room for the market to move higher between now and year end, but more of the cyclical components of the market rather than the long duration stocks. So in terms of structural positioning, although we don't pick sectors and themes, what I would say is that on the long book, we have more cyclical type names in the fund. So companies which are shorter duration have a cyclical component and are attractively valued, and rather less of longer duration, very highly rated companies which have performed well over the past few years, primarily because of interest rate moves, which we now think won't help them any further. So our individual long picks going forward, as always, are picked because of their intrinsic characteristics, but they do seem to reside more in cyclical type sectors. So I'll highlight a couple of long names that we think are interesting. So TUI in Germany is a tour operator, activities around Europe, UK, Germany, France, Scandinavia. Essentially, the company derated aggressively during 2016 because of concerns in the macro area about terrorist threats, especially shocks to Turkey and North Africa. Now we think TUI's model is well insulated from these shocks. Most of the hotels they own and their activities are in Spain. And so as tourism moves from North Africa and Turkey towards Spain, it actually gives their business more pricing power, and their hotel group can actually improve its pricing. And so it's on a net basis, it can actually be beneficial that there's been these macro shocks. But more important than that, from conversations with the company, we think that gradually they'll reduce their exposure to the straight tour business, and they'll invest more in hotels and cruise liners. So cruise liners is a long-term growth area. Market's growing more than 5%. Refurbishment and new equipment means that they can meet that demand and grow in a sustainable way through high-quality assets. They're also investing in their hotel business to grow their exposure further in Southern Europe and also in the Caribbean, so that the earnings mid-term will be rebalanced 50-50 between tour operations on the one hand and hotels and cruise liners on the other hand. Now this mix shift will drive a good re-rating through time. So the stock declined by about 30% this year. Then I met the company in Germany at a conference, and the valuation is now attractive. The PE is only 12 times forward earnings. Dividend yields about 5.5%. And gradually, over the next 3 years, they'll change the mix of assets so that they move towards a higher quality earnings mix, and that will drive a reasonable re-rating of the stock, we think, over time. So we think there's about 30% upside to this company over the next 18-24 months. Other long names that we like, which we've held in the fund before, are Technicolor in France, which is a media company. It basically manufactures set-top boxes, has a visual effects business, and has a DVD production business. Essentially, this business, again, is being repositioned. It's moving away from the lower margin activities, such as set-top boxes and DVD replication, more towards the faster-growing areas within media. So they have a really good business, a number one global leader in visual effects. So visual effects are used in movies and in adverts to basically enhance the experience for the viewer. So in a typical movie, a budget of $100 million, an expensive one, $30 million will be visual effects. In the adverts that you see for the automotive industry, lots of the cars on display actually don't exist. They're generated through these visual effects. This is a long-term growth area, and with the advent of virtual reality in lots of areas, it's going to accelerate the growth. Technicolor are well positioned to benefit from the acceleration of the growth in this part of their group, and use the other parts to generate cash flow through time. So talking about cash flow, as you know, the yield on most assets around the world is very low. So yield on bonds, extremely low. Yield on prime property, also still low. If you look at a company like Technicolor, its free cash flow yield on our estimates is 9% at the moment, moving to 14% by 2019. Now, if this cash is only used for deleveraging or is reinvested at a reasonable rate of return, then it should mean that it generates a good re-rating of the business. And in European equities, given what's happened, and given what's happened to the earnings path, there are stocks available which offer free cash flow yields which you can't access anywhere else. So it's not just these names, in lots of mid and large cap names, excluding the financials, which are more a special case, excluding those, the dividend yield or the free cash flow yield can be easily between 4 and 5% on dividend, 7 and 8 on free cash flow, which I think is attractive compared to most other asset classes. And so in terms of the short book, that's composed of individual names where we think there might be a specific issue because of trends going on in their industry. So I would highlight Into in the UK, which is the owner of shopping centres. It owns shopping centres around the UK and a small amount in Spain. And in terms of retailing, the trend is either to buy online or to go to huge shopping malls, which are basically showcases for all the major brands around the world. Into sits in the middle between these two forces, so they have mid-sized shopping malls where footfall is gradually being eroded. That erodes the power they have over their tenants to increase rents and gradually leads to negative operating leverage. They've expanded quite aggressively over the past few years without generating any free cash flow. So we think that they're going to have to either dispose of some assets, which will probably be at lower valuations than their current one, or generate free cash flow through some other means. But we think that's a reasonable short idea at the moment. And then the other one, I'd mentioned, is an industrial in Switzerland, which is Oerlikon, which manufactures textile machinery equipment, and also has a business which does surface solution equipment for the aerospace and automotive area. We think that the demand environment has slowed down in certain of their end markets, and we think it's unlikely to accelerate in the midterm. The group's done a reasonable job of reorganizing the business mix, but we don't think it's enough to justify midterm consensus earnings estimates, so we've been short of that. So in general, in terms of the position of the fund, like I say, it's more in shorter duration, cyclical type names. The top 5 positions are all in, I would say, cyclical sectors: media, travel and leisure, automotive, and less in longer duration names. And the shorts are a mixture of both. And in terms of our overall view on the market, we'd say neutral to mildly positive for the moment, given the free cash flow yield on offer in Europe, and given the fact that earnings estimates are now reasonable for the year. So that's basically the position of the fund at the moment. Any specific questions?
Mark, a question regarding M&A. Do you have position that could be acquired from a competitor in the US, in other countries?
I mean, essentially, we think the valuations of the names that we hold are attractive, and the European market is cheaper than the US market. So we think that there's a number of names where there's been potential speculative interest. So Entertainment One, which I mentioned, has already received one bid. The stock was bid for by ITV in the UK in August at £2.36. The stock's about £2.20 at the moment. The shareholders considered the offer too low, and I did as well. So the offer got rejected and the bid got withdrawn. But because it's a good quality manufacturer of media content, which goes around the world, there's huge demand for this type of content, because there's lots of distribution channels you need to attract audiences. Because they're a prime leader in that, the asset's very attractive, so there could easily be further interest in that. I mean, there doesn't need to be to crystallize the investment case, though. We think fair value on a 2-year basis is around 325, and the stock's 220 at the moment. So it's good fundamental upside. That could be crystallized quickly if a bid appeared. And then some of the other names, some of the technology names we hold, there's been consolidation around companies with exposure to the autonomous driving segment. There's consolidation around sensors and suppliers to the consumer electronics industry. Yeah, we have named the technology sector in Europe, which could benefit from that. So a number of names which could potentially be of interest to other companies in their sector, but we wouldn't hold it just for that reason. That would just be an added benefit if it came.
Mark, another question regarding Brexit. The Brexit was an occasion to increase your position in the UK or not?
Well, in hindsight, the Brexit was a short-term buying opportunity. But the way we picked our UK names is on a bottom-up, stock-specific basis. So, straight after the Brexit, the valuations of all the mid-cap European stocks dropped. Mid-cap UK stocks fell. And so we added a little bit to some of the UK names where we thought there was good upside. So I bought a little bit more Entertainment One after the weakness. But the reason why we hold it isn't related to the domestic UK view. It's more the fact that the company is domiciled in the UK, but has exposure around the world. So we didn't take a directional view on the UK economy, but we added to some of our smaller names into the weakness afterwards. Just one more point, just in terms of the position of the fund. On the long book, we think there's 45% upside on a 2-year view, on average, to our long names, and between 10 and 15% downside on a 2-year view to our short names. So after a difficult 2016, quite difficult, we think that the fund has enough return potential in it to meet the midterm return target in the next 12 months.
Mark, a question regarding the short side of a portfolio. Are you using more option or future indices to hedge your long position?
Yeah, the short side basically is composed of some individual names and then some sector baskets to hedge the exposure on the long side. So a healthcare basket and a technology basket. And then some out of the money options. So given how low volatility is, there's obviously reasons why people can point to why volatility may rise between now and year end. There's obviously a US election, there's elections in Europe. There's discussions about Brexit restarting. So there's lots of things which could happen, which could mean volatility rises. So we hold puts on the US stocks index now because we think that volatility is at quite a low level, and they represent 10% of NAV. And so they are there to basically defend the longs from a rise in volatility.
Thank you, Mark. Other questions?
Mr. Bessetti, Mr. Chapman, there are no questions registered at this time.
Ok, thank you so much, Mark.
Thanks.
Ok, il team marketing di Edge Invest, come detto, a disposizione, poi se avete qualsiasi tipo di curiosità, domanda specifica. Vi ricordo anche che è stata appena pubblicata un'intervista di Marc sul Sole 24 Ore, la trovate sul website. Noi ci risentiamo alle 4 per la conference call di aggiornamento invece sul fondo Numen Credit. Alle 4 ci sarà in italiano, successivamente quella in inglese. Grazie a tutti, thank you, bye bye.